Welcome everybody to the Hamilton Wealth Partners Fund Manager series. Now this series is in addition to the Thought Leader series you may have attended over the last few months. It's also in addition to the Quarterly Outlook series which we launched last week. So this series we've launched to provide our clients with a deeper insight into some of the managers that we partner with, providing you with some thoughts on how they look at markets, their philosophy, their process, all those sorts of things. The layout will be the same as previous webinars. So we'll have a guest speaker speak for roughly 20 to 30 minutes, and then we'll open up for questions at the end. So any questions that you have, please post these in the Zoom taskbar. Now I'll begin by going through a brief general advice warning. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation, or needs. You should, before making any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate, having regard to your objectives, financial situation, and needs. Now, having said that, I'll introduce our first speaker, who is Jamie Nicol from Dalton Nicol Reid. Jamie has over 27 years of experience in investment markets. Prior to founding DNR in 2001, Jamie held senior roles in company research and analysis for two major stockbroking firms, as well as Westpac in their mergers and acquisitions team. He commenced his career at PwC in audit and tax and holds a Bachelor of Business, Bachelor of Economics, and is a fellow of the Australian Institute of Chartered Accountants. So now I'm going to pass over to Jamie, and like I mentioned, we'll open up for questions at the end. So over to you, Jamie.
Yeah, well, thanks very much, and thanks for your time this afternoon. I'm here to have a chat about DNR, who we are, our core investment philosophy, and just what we've been doing through this period during of great volatility and uncertainty through this COVID period. So DNR, as mentioned, we've been operating since 2001, so it's a 20-year track record now in Australian equities. Team of about 30 people looking after about $5 billion across a range of different strategies. The key ones that we're talking about today is the high conviction strategy and our socially responsible strategy. It's a team of, we've got about 30 odd staff, and I think what we find attractive about the business is it's independent business, staff own equity in the business. I think that's really important in terms of driving alignment and accountability with end clients. You know, I think working for yourself certainly energises our key staff members, and certainly helps us to attract good staff ultimately from different firms around the globe. When we talk about our investment philosophy, it's about buying quality companies at attractive valuations, which many people make the obvious comment. I mean, who wants low quality companies at expensive valuations? Which is a fair sort of point. So what we like to do is identify what we mean by quality, because quality does mean different things to different investors. When you think about buying a property, people are very clear about what's an A-grade office property or a C-grade property. Likewise, if you buy bonds, AAA rated bonds versus junk bonds is very clear in people's minds. It's not so clear in investors in equities' minds. So the way, so there's been some academic research done on this, because the research sort of suggests if you have a focus on quality, you can drive out performance through a market cycle. And if you overlay it with valuation discipline, you really extend out that period of outperformance. But what we mean by quality is we identify 5 key characteristics. The first one is a strong industry structure. And that's the sort of Buffett idea of barriers to entry or a competitive advantage of a company, so it can continue to reinvest capital to drive growth over time. It's companies with earning strength, good returns, a good return above its cost of capital, and that enables again good growth over time as it's reinvesting capital. But you don't really want to invest in a return that's deteriorating. So really trying to get that incremental improvement, because I think that ultimately drives share prices. A good balance sheet, particularly in this sort of period, is really important. Creates a lot of strategic flexibility for companies. You don't have to worry about companies going broke, which eases concerns during an uncertain period. Good management, good management to be able to allocate capital prudently and successfully to drive growth over time. And then overlaying that with looking at the sort of ESG risks, the environmental, social and governance risks. As we've seen over the years, analysts can often underestimate the sort of risk that comes with poor governance or poor sort of environmental controls, and investors can be a little blindsided when events arise, which causes concerns to regulators or others, and has an impact on the share price. So we put those 5 things together, and we and try to identify which companies on average score well on those particular points. And when we find a good quality company, we then overlay that with a valuation discipline. And the idea is, as I said, these good quality companies can reinvest to drive growth, but they often, if we're a little early in the investment cycle, you can ride out that cycle because you've got the good balance sheet, you've got the quality business, and investors are quick to return to these type of businesses as you go through a cycle. And sort of an issue we haven't had to deal with for quite a while is inflation, but good quality companies can often pass on inflation to their customers. And I think it's something to bear in mind, given that we're in a process of significant fiscal stimulus. I think governments around the world would like to see a little bit of inflation emerge to help chew through the sort of debt that's being created through this current period. We obviously recognise that a lot of others are looking for these type of companies as well. We're not alone in that regard. And for us, that valuation discipline is important. For us, we look at 3 main types of companies we like to buy. We're trying to buy companies with improving quality, so it's not yet priced by the market. So it might be a company that's repaid its debt, and so it might have had a perception of having too much debt, but that's no longer the case. Or it might be a company that's consolidating the industry structure, and so you've got an improved industry structure and a good ability to increase returns. A couple of stocks that sort of sit in our portfolios in that regard that we've just added in more recent times has been a company like Telstra. Telstra is a stock we haven't owned for 20 years. And over the past 20 years, it's gone through a very difficult period. It was such a dominant player, yet as the internet came in, it took away its revenues in Yellow Pages, in Trading Post. NBN's taken away its fixed line opportunity. So many parts of its business have been competed away. But what you're left with now is a mobile business and an infrastructure business. And we think, they're pretty sound businesses. Telstra's got a strong market position, so they're much more investable now. And we really do see it as one of these improving quality type plays in the portfolio. The second opportunity that we like to exploit is a derated quality business. That's where the market goes through a period of volatility. You get a great quality business trading cheap. And obviously March there was a plethora of great opportunities going through March when the market fell 38%. And we really took advantage of that through that March period. And great industrial businesses in the high conviction portfolio, stocks like James Hardie, REA Group, which is the realestate.com, Seek. There were some fantastic businesses trading 50% down due to the heavy uncertainty around COVID. And we'd like to take a longer term view on stocks. So if you can look through the near term uncertainty and look at what's a great business trading cheap, then that's a good opportunity to step in and buy them. Then the third opportunity is just where you get a good quality business where we're taking a longer term view and you're thinking about the reinvestment cycle and you're thinking about what this business can look like in 5-10 years time. And it's always important to take the longer term view when you're investing in equities, because I think markets get very short term. Nothing illustrated that more than that March period, where markets looked about 2 inches in front of themselves and really started getting concerned with very short-term earnings. Clearly, businesses were shut for a period of time, while we were in lockdown. And we thought a good illustration was markets gravitated to stocks like Metcash, which owns IGA supermarkets. That stock was up 30% in March. We thought it was like a toilet paper trade. People were observing people lined up to buy toilet paper and happily bought the stock. But one month's good profit doesn't really do much for your share price. It's really about, is there any change to the long-term competitive position of a stock like IGA? And from our perspective, there's clearly no. And that stock subsequently sort of has rolled off quite a bit. So I think that's the sort of opportunities that we're looking for. If we can find a good long-term business, and for us, sort of one that's really fits the mold that I'm getting quite excited about is Domino's Pizza. Now, you may not like the pizza. Not many of my investors that I talk to do, but it's a great business model. And there's a reason why franchise businesses around the world have traded at great prices for a long period of time. It's because they're very low capital intensive. The capital is provided by the franchisees, and the franchisor makes a clip along the way and continues to grow into new markets. And at the moment, particularly during COVID, Domino's introduced its product in Germany and Japan in particular, and it's really taken off. And Japan's obviously a huge market. What might surprise you, and it certainly surprised me, was that 30% of Japanese households are single people households, which is kind of sad, but they're sitting there playing Xbox, eating Domino's pizza. So good for Domino's. I don't know about their social life, but so we think the fact that they've got introduced to Domino's, downloaded the app, the big market, that'll produce sort of really long-term growth. And likewise, Germany. What typically happens is you get to critical mass in a market like Germany. There are 300 stores. The next biggest is 100. They start advertising on TV, on the internet. They have their $5 offers. It's very difficult for the number 2 player. It becomes a virtuous cycle. The franchisees in Germany cock a hoop. They're making so much money. They want more stores. And Germany is an $80 million country, 80 million population. Could easily have 3 times the number of stores as in Australia, which is about 800. So they're currently at 300. So that sort of drives a 10-year sort of growth story. And while Domino's has been a really big success for us over the past year, and you could see some weakness given it's had such a strong run, it really is a stock that we like on the longer run. So it'd be a stock that we'd be looking to add to should we see some weakness. So I've jumped around a little bit there, but I sort of highlighted when we went through COVID, the key thing we did with the team. It was a very unsettling period, unsettling for analysts, and it was really important just to sit people down and work through the stocks in our portfolio really pragmatically. Work through, is the balance sheet okay? Do they have enough liquidity? So are they going to survive? And if they're going to survive, then start running scenario testing around the earnings. What's the best case? What's the worst case? And if the stocks look cheap on the worst case, then we thought it was appropriate to start buying these stocks. But we didn't really want to buy them on the outlook for 3 months' earnings or even a year's earnings. We were really looking through to 2022 because earnings have been so disrupted in the short term. We thought it would just give a complete misread in terms of the valuations of the company. But of course, looking through the 22 contains risks. It's still a period of uncertainty and still a period of tremendous opportunity. So subsequent to then, we're out and about, not speaking to not out so much over Zoom and over the phone, speaking to companies, speaking to customers and competitors. And we think the opportunity is to really understand what's going on inside the businesses that we're investing in, because it is difficult to forecast and there's going to be some mispricing as a result and some opportunities. And most of what's really been surprised us since COVID is most of the surprises have been to the upside. And that I think the trough is just a little less deep than what we feared. We're not so sure 22 looks that much better, but certainly 21 looks a lot better than what we feared. And I think that's thanks to the government stimulus and also just the flexibility of some of the companies and the ability to work from home. And I think it just shows human resilience really in terms of the ability to tilt and to continue to operate. So that's been a pleasant surprise. Might just give you a couple of examples of these positive surprises, because when COVID hit, and a stock like James Hardie, which is involved in housing starts in the US, we were expecting new housing starts to fall by about 20% in 2021. At the moment, they're up about double-digit growth rates, which is a real surprise, but it sort of highlights that there wasn't an overbuild in the US. Low interest rates stimulated demand. I think stimulus has also supported it. So they're doing incredibly well, and we're still forecasting -8%, and we're probably broadly in line with the market. So we still think if it holds up, there's good profit upgrades, and that company's performing extraordinarily well. Likewise, REA Group, which does the when you're going to sell your home, you advertise on realestate.com. We were probably expecting a pretty soggy outlook for this year, given just the uncertainty. I mean, a few months ago, we were worried that there wouldn't be any auctions by now. So, that's all up. And I think in Sydney and Melbourne, over the past month, the increase in advertising from a year ago is up about 28-30%. So it's up quite a lot. At the moment, the market's forecasting about 8% revenue growth this year. So again, it's sort of like a potential for quite a significant beat should that hold up. We're seeing this time and again, particularly of retailers, Bunnings and other retailers really benefiting from both the stimulus and the lack of alternatives, as people don't spend as much money on entertainment or travel, so they're funneling it into retail spend. A lot of the retailers doing very, very well. Now, we're cautious on some of those, though, because we're not sure that's a sustainable level of profit. So while I was cautioning in March not to get too bearish about short-term earnings and look through the 22, I apply the same lens when thinking about short-term wins due to stimulus. You really got to look through that and think about what's the long-term sustainable level of earnings. And you should be pricing off that. So you can get mispricing both ways. I think as we've gone through the strong bounce, we feel the risk return's got a little bit more balanced, and we've looked to trim some of these winners like Wesfarmers, Hardies. They've done very well. We still think they look pretty good, but we just think it's sensible to trim some of that, and we've picked up some slightly more defensive stocks like Telstra, which, as I mentioned, has that improving quality characteristic. So on a go-forward basis, we think there's good bottom-up opportunities, but you need to be really active, and we need to be in touch with the companies, in touch with the competitors, and be reasonably nimble at the moment, because it is changing week to week, as we see with the Victorian lockdown. You want to remain open to the shifting sands a little bit around that longer term outlook. We've got the combination of the stimulus versus the uncertainty of the virus and the potential for vaccine. So there's a lot of factors at play, and we're just working through those on a stock by stock basis. Clearly, there's some opportunities though as well that's emerged. I think some of the mid-cap names for us have presented really interesting opportunities. That's sort of mid-sized businesses which we think can potentially grow a little faster. Just to highlight a couple of names which we think are interesting. ALS, Australian Web Services. It's a 150-year-old company. Used to make soap many years ago. It's now a testing business, and it tests both in environmental and food and water. And it's got a testing service for COVID. And so if a McDonald's has an outbreak in a store, they can bring ALS in to test, clean, test. Potentially they're a global player, very big globally. So interesting opportunity. Then the other part of their business is minerals testing, where they're a global leader, and in particular gold. And gold juniors are really raising a lot of money at the moment. Gold price is very strong, so we think they'll do very well out of that. We like that business. We just think it's a very well-run business with globally a leader with a strong market position, good technology use. So sort of type of business that we like, those market leaders. Other one is Iris. Iris is a financial services software, provides software to our business. I assume your business as well, Kane, but they provide software to a lot of fund managers, a lot of financial advisors, but they're also tapping into the superannuation market and the financial platform market. They're very big in Australia, South Africa, the UK, very dominant market position. It's not trading all that expensively for a strong software business that's opening up new markets and has been growing its revenue at 10% per annum. So very good cash flows, conservative management, market leader, all those sorts of characteristics that we love as a good quality business. So I might just pause there, and I'm happy to go back to any of those areas, but if you'd like to, any questions, Kane?
Thank you, Jamie. That was great. So we'll open up for some questions now. If we don't get any to start, I might start with one. So I'm just getting it. Okay, so Jamie, it's our belief that it's going to be a very positive environment for active managers compared to passive going forward. What sectors or companies, therefore, are you positioned towards as the winners, and what areas are you looking to avoid as the losers? I know you touched on a few just then, but if you could elaborate a bit.
Yeah, just to elaborate, from a sector perspective, we're underweight those ones where you have to take too much of a bet on the economic direction. Banks, some more cyclical stocks like travel companies, those ones at the pointy end of COVID. It's a bit too much. The strength of those businesses isn't there. Their returns have been deteriorating. They're facing greater competition and a deteriorating economic backdrop. Not all that appealing. Whereas a lot of the companies we're in, good balance sheets, they're winning market share. So Cochlear, the ear implants, James Hardie, Aristocrat, REA Group, all of these companies are winning in their fields. And what that means is even if you go through a negative cycle for a period of time, when the cycle turns, investors are pretty keen to go back those sorts of companies, which is why they saw a very strong bounce post-March.
Thank you, Jamie. Another one, we appreciate DNR, your stock pickers, but what are your expectations on volatility from this point?
Look, the key thing driving market performance, we think, is, well, there's been a recovery, obviously, and we went through the worst of COVID, but very low interest rates and a lack of alternative investments has attracted people to equities and will continue to provide support for equities. But their starting point is, reasonably full valuation. So we think equities will offer better returns than most asset classes over the medium term, but you should be expecting volatility as we to and fro between uncertainty around US election, uncertainty around the trajectory of the recovery and through second waves and the like. So I think you always expect volatility in equities. I think you expect more at the moment, but I still think it's better than the alternatives on the longer run.
Great, thanks for that. So we've got one here from Campbell Andrews. He said, hi, Jamie, what typically causes you to sell a stock holding?
Yeah, great question. I mean, there's two things that trigger a sell. The most important one is where we see the quality characteristics deteriorate. And a good example of a sell recently was Worley Parsons. It wasn't a particularly successful investment for us, but there was some pretty significant changes to the external market with the oil price deteriorating rapidly post-COVID as demand deteriorated. And I just got concerned that with demand deteriorating so much, it was so dependent on the Saudis agreeing with the Russians and the Venezuelans and keeping a very fragile coalition together to manage the supply side. And when you're dealing with Worley, they do the capital investment in major projects, and you're talking about $5-10 billion projects. To get that to the size projects up in such an uncertain external environment just looks really difficult. So I think the improving trajectory the reason we were in the stock had gone. So the thesis was dead, and it's important when the thesis changes, when the quality characteristics deteriorate, to get those sort of stocks out of the portfolio. There's also valuation, as stocks, and that hasn't been a great reason to sell over the last couple of years. Growth stocks and the higher price stocks have continued to trade at ever higher levels over the last couple of years. And typically we trim stocks which are running to rotate into stocks which offer a little bit more value. We don't so much outright sell on valuation grounds unless it really pushes the friendship. And there's been a range of stocks that I mentioned earlier, like Wesfarmers, which is looking a little expensive at the moment, and we've trimmed that, but it's still a company that we think is a great business in the longer run. Domino's is pushed up a little bit, and we've trimmed that a bit. Those stocks pull back, we'd be happy to step back in. So it's been more about trimming those ones than selling outright.
Great, thanks for that. Now we've got one from Michael Noakes. He's asked, how much cash do you carry and how did you fund purchases that you made in March?
Yeah, it was two areas to fund it. I mean, we go up to, we don't hold cash as a tactical asset allocation. We go up to about 5% cash. So going into March, we were sitting at the upper end of that. You were sitting at about 5%. So you had about 5% to deploy. Then you had some stocks that held up particularly well or performed particularly well. So I guess that's the third reason you might sell, is that you find a better opportunity. So stocks like Wesfarmers or Domino's, and there were others that Xero performed incredibly well through March. So there were some stocks that just held up incredibly well that we're able to deploy into some of these stocks which got beat up pretty badly through that period.
Okay, thank you. We've got another question here. Can you please explain the difference between the socially responsible portfolio and the high conviction strategy? Yeah,
good question. I mean, we both are managed. I manage both of them with Scott Bender, with co-portfolio managers of both. So they've got got some similarities. We look at ESG across both, but for the high conviction, we're more looking to avoid risk areas that haven't necessarily been priced by the market. Whereas across the SRI, we want to invest in stocks which pass. It's absolutely critical that they pass our ESG screen. We want to bias to some companies doing good, and we'll exclude certain areas of the market like gaming, like companies which perhaps it does not invest in Domino's, for instance, because it contributes to potential contribution to obesity. So there's some differences such as that. What we found over the years is we tend to have a slightly bigger, we have a bigger mid-cap bias to the socially responsible portfolio, because it won't invest in a Tabcorp or some of the larger companies that are in the high conviction. So we use it to pick up some more mid-sized companies like Breville, IPH, some great businesses that have been growing really fast, and they've done a great job for their socially responsible. So we think it's the way we see it's all about buying sustainable businesses, and part of that's growth, part of that's ensuring they've got sustainable environmental, social practices.
Great, thank you. One last question I've got. Given the bounce we've seen in markets and the lack of transparency around earnings due to lack of guidance that a lot of companies have provided, are you finding it difficult to find value in this market? Yeah.
Look, I like the fact that companies, to your point about active management, I love companies not providing guidance. I hope they keep that practice, because too often, analysts, we can all be pretty lazy, and we just price to where the market's pitching guidance and wait around for the results to see if they beat or not. If there's no guidance out there, it means a lot more bottom-up work on our behalf to see how they're going, and I think that presents opportunities. So I'd love them not to do that into the future. To me, I'm absolutely not worried about 20's earnings. I don't think it matters. I think it's about looking through to 22. The hard part is, that's 18 months away before we start sort of really getting an understanding what 22 is going to look like. So the way I describe it to my team is, you feel like you're a jumbo jet pilot trying to find the landing, being 22 earnings, and it's moving around on you as you look forward. that presents the opportunities. It's about us doing the work around that. Where there's value in two areas. There's clearly value in the stocks most affected by COVID. Travel stocks, for instance, casinos, things like that. That's a pretty binary outcome. It depends on how we recover, whether we get vaccine. If we get a vaccine, then the whole market's going to be, squeezing through the one door trying to buy those sorts of stocks. They present value, but with a lot of risk. And there's no shortage of value, but you just got to take on a significant amount of risk. So we're not that comfortable on a risk return on some of those. So we go up by sticking to our quality discipline, but trying to find where there's value. We try to isolate, things which look a little bit more attractive from a risk return basis. An example of one we bought recently was Computershare. So we bought that on about 12 times earnings. It's a great business. It's big cash flow, great market position, market leader in share registries, and it's got a good operation in the US and the UK. But over the last couple of years, it's leveraged to lower interest rates. So its earnings have fallen, its interest rates have fallen. But where interest rates are now, if interest rates were zero across the globe, earnings would only fall by another 20 million. So limited downside, but then it does a lot of counter-cyclical activities. It does bankruptcies, looks after mortgage foreclosures, looks after, if there's capital raisings, it makes more money. So there's the market's sort of factored in the down, hasn't factored in the up, and yet you're getting it cheap for a good quality business. So there is opportunities like that. There's no doubt, though, that there's some expensive parts of the market. And as I was saying before, what's been unique, unique's too strong a word, but unusual, it's been this very big run in growth stocks. And if you're a tech name with a strong amount of momentum, perhaps a healthcare name, a lot of money is gravitated towards those stocks. They're not particularly affected by COVID either. We're a little cautious around valuations of some of those, and particularly at the speculative end, like an Afterpay or some of those buy now, pay later, where it seems the enthusiasm's got a little bit too heady for our liking.
Well, thanks for that. One last question we've got here is from Campbell Andrews again. What is your view on Sydney Airport at the moment?
Yeah, it's a tricky one. It's potentially pretty interesting. I guess the way we're thinking about Sydney is, they're earning nothing for the next year. It's probably for the next 18 months, it's not earning very much at all. Your long run outlook hasn't probably changed all that much. Depending on when we get back to normal, is it 22, 23, 24? By the time we get back to normal, it'll probably be, it's a good asset. It's the gateway to Sydney. If we're all travelling again, it'll be back to earning a full amount. Potentially it's got a capital raising. I think it's got too much debt, particularly in the light of this type of activity. I think it'll want to carry a little less debt. So we think it should raise about $1 billion just to reduce that debt load. If it does, that could be quite interesting. I'd really like the potential of that. It is a little binary on us progressing, and we did buy that early on. It felt like we've got a little uncomfortable with it. We made some money on it, but just got a little uncomfortable just because of that time horizon just getting pushed out in terms of recovery. So we backed away from that, feeling like there was better opportunities.
Great. Well, thank you very much for that, Jamie. Now, this concludes the webinar. We hope you gained some valuable insights into DNR. And if you've got any further questions, don't hesitate to contact us. Thank you for listening. And we will be following this up with another webinar invite coming out shortly. So thank you.
Thanks very much, Kane.